Hey guys, this is Jamaal Hobson with Rule 1, and I want to tell you a little bit about the Rule 1 strategy. The Rule 1 strategy is very simple. We find wonderful companies and we buy them when they're on sale. That's it. That's all there is to it. We find a wonderful company, we buy them when they're on sale, and when they get overpriced, we go ahead and let them go and invest in the next wonderful company that's on sale. One of the way that we determine if a company is wonderful here at Rule 1 is by the use of these 5 metrics. All right, we've got book value per share growth rate, earnings per share growth rate, sales per share growth rate, our cash flow per share growth rate, and then return on invested capital. If we've got all 5 of those metrics all giving us a good, then we may have ourselves a wonderful company. The book value per share growth rate. What we're doing is tracking the retained book value that the company has or equity that the company has, and if they're able to grow that equity over time consistently, okay? For earnings per share, we're looking at net income or the earnings that a company produces. And we like to see, again, consistent earnings growing over time, year after year after year, for at least a 10-year period. Sales per share, we're looking to see if the revenue that the company is generating each year, is that revenue or sales, is that number maintaining or increasing? We don't want to see that number decreasing in any way. Cash flow per share. This is what the company has, the cash that the company has to do whatever they want to do with. And we want to take a look as an investor to make sure that company has enough cash to service any debt and be able to take care of future growth. Simply put, return on invested capital is the return that management generates off of the cash that they have, including any borrowed money. And we like to see a return on invested capital consistent, something above 10% year after year over about a 10-year period. So free cash flow is the cash that a company has left over after they've taken care of all of their responsibilities. And as a ruler, we want to see that free cash flow. We want to see a pile of cash there to know that the company can service any debt that pops up or handle any sort of vicissitude, as Charlie Munger would say, and still be able to continue growing beyond that vicissitude. So we love to see companies with positive cash flow and to see that cash flow growing year after year after year. As a ruler, debt is extremely important because it is extremely dangerous when it comes to investing in these wonderful companies. We do not mess around with debt. So if a company has more than 3 years worth of earnings in debt, we immediately take it off of our list because we don't know if that company is going to be able to service their debt should some rough weather come their way.
For you guys and for me, where we want to be extremely risk averse, we don't want to be involved with businesses that have this problem that could force them to get rid of us as owners of the business. So I would be very, very careful. No matter how good it looks, no matter how much money they're making, be very careful with stepping into that kind of an industry. In fact, any kind of an industry where there's a lot of debt.
A lot of this information that we're talking about comes straight from the company's 10K, and we love to view this information right there in the toolbox where we've got the company's annual reports, their quarterly reports, their financial statements, everything aggregated together to help tell that story of, is this company wonderful and what price do we want to pay for this wonderful company? So if you can learn how to research these companies and use these metrics to identify how wonderful they are, then you'll be able to be a ruler and invest the same way that we do in these wonderful companies.